actual AS paper, I think, in, when was it? June 2018. So you may recall that this is the only budget now that's in the AS. It used to be cash budgets that were in the AS, but they decided to switch it around and put the budgeted income statement and statement of financial position in the AS. And then, as I said, came from an AS paper. So if we just have a little look through the information, what we've got to do is prepare the budgeted trading section of the income statement. So we're not doing the whole income statement, it's only the trading section. And this was worth 15 marks, so quite a lot of marks, but quite a lot of work to do. So things we need to remember then when we're doing the trading section is that we've got some figures usually to base it on from the previous year. And we've been given the actual income statement, this trading section, for the year ended 30th of April 2018. And we're doing a budget for the year ended 30th of April 2019. Excuse me. So we can see that last year they sold 12,000 units. And if we divide the 2160 by 12,000, that works out at £180 per unit. So we can come up with things like the selling price. We can do the same with the purchases. We've spent 1.44 million, so 1.440 million on 12,000 units, which, I don't know what's gone on there, 1440 divided by 12, which gives us a price of 120. So last year then the selling price was 180 and the purchase price was 120. And the inventory has been maintained at a steady level, 2,000 units. So they've bought last year enough units to satisfy all of their sales. So it says there that the management accountant provides the following forecast for the year ended 30th of April 2019. It says that both sales and purchases will be spread evenly through the year. So revenue, it says it's intended to reduce the selling price by 10% from the 1st of May 2018. Well, the selling price was 180, so we need to knock £18 off of that, don't we, to come up with the new selling price. So by my reckoning, that's going to be a selling price of 162. And then it says that the forecast is for the period from the 1st of May to the 31st of October, sales volume will increase by 15%. So remember, sales volume last year was 12,000 units. So for this 6-month period, it's going to be half of that. So 6,000 units plus 15% of the 6,000. Okay. So whatever figure that comes to, let's just work that out. So 6,000 units is 6 months, because the sales were accrued at 1,000 units per month. It's 12,000 for the year. So I reckon that's going to be 6,900 units for that period there. So you might want to check that if you've got your calculators handy. 6,900 units. For the rest of the year, the sales volume will increase by a further 10%, and that's based on the sales volume for the period from May to October. So you need to get this figure, this 6,900, before you can get the figure for the rest of the year. So 6,900 plus another 10% is going to give us 7,590 for that second 6 months. And remember, all of that is going to need to be priced up at the new selling price, which is 180 minus 10%, so £162. Okay. Purchases, it says it's intended to purchase 15,000 units. Okay. So when you come to work out your trading section, you've got 2,000 units at the start. So that closing inventory from last year will become opening inventory for this year. Purchases are going to be 15,000 units. You're going to need to work out what the closing inventory is in units and cost that at the latest price. Okay, so that's going to be the balancing figure. Remember, sometimes purchases is the balancing figure, but in this case, it's going to be closing inventory. You know what opening inventory is. They've told you what purchases are going to be, and it tells you there that the current supplier has informed the company it's going to be increasing the price to £130 from the 1st of May. So the purchases are all going to be at £130 up until the 31st of July. Okay, so for May, June and July, £130. So you need to work out what that's going to cost. And then the purchasing manager has found a new supplier who is willing to supply the product for £120, but they will charge £5 a unit for delivery. So remember, that's carriage inwards, so that gets added. So the actual cost price there is effectively £125. And it does tell us up here, if you just remember, that both sales and purchases are going to be spread evenly through the year. So these 15,000 units are going to be bought at an equal rate every month. So you need to divide the 15,000 by 12 to find out how many units. Remember that inventory is going to be valued at the latest cost, so that's the £125. So it'll be including the delivery charge. So, right, let's have a look. There's the answer on a PDF. Okay, so yeah, sales revenue then. We had to work out the number of units that we were going to sell, which was, let's have a look, let's find the sales revenue calculations. There it is. So 12,000 was the volume of sales last year, so that's 1,000 a month. So for a 6-month period, that would have been 6,000 units. In the first 6 months, that was going to be increased by 15%, they thought. So that would have meant selling 6,900 units. And remember, the selling price was 10% lower than last year's, so each one was 162. So 1,117,800 for the first 6 months. And then the second 6 months, you've got to pick up that figure, that's 6,900 from the first 6 months, pick that up again and increase that by 10%. So the second 6 months, the sales are going to be 7,590, but still at the same selling price, £162. So revenue there, 1,229,580. And when we add the two together, we get the 2,347,380, which, if you remember, is lower, or no, slightly higher actually. 2,160 was the revenue last year. The opening inventory is just the closing inventory from last year. So if we have a look there, closing inventory, £240,000, which was 2,000 units at the, was it £130? So we've got, oh, it's 120, I don't know what it was last year actually, but we don't need to work that out. Purchases though, if we have a look at the workings for purchases, we're purchasing 15,000 units, but for the first 3 months, 3,750 of them are going to be at the £130 because they've got that contract that takes them through till the end of June, I think, haven't they? Or June, the end of July. So 487,500 for that. And then the new supplier is going to charge £120 a unit. But why have they done carriage inwards separately? Ah, yes, they've shown the carriage inwards separately. So it doesn't matter which way around you've done it. If you've thrown it all in together, it's not the end of the world, but they've done the £5 a unit times the 15,000 as a separate figure there. So as long as you've got, if you've done the two together, which is what you need to do for the closing inventory, 1,837,500 plus 56,250. So if you've got purchases of 1,893,750, then you would have got those 4 marks there. And then closing inventory, I went through the calculation. It's on the Google chat thing. Closing inventory based on the 15,000 units that we are going to buy. We're selling 14,490. We're going to be left, we had 2,000 at the start, left with 2,510 units. So 313,750 for the closing inventory. So yeah, all of that added together, 1,820, 00 or 000 for cost of sales, leaving us with a gross profit of 527,380. So if we were asked to comment upon this budget, if we compare that, as Dylan said at the start, the gross profit is lower than last year. So what they've tried to do here is reduce the selling price to increase the volume of sales. They've actually increased in revenue, but because of the increase in the price, the purchase price and the carriage inwards, it's not really worked. They're actually ending up with a lower gross profit figure than they would have done. Is everybody okay? Workings up there. So the revenue is there. And then we've got the purchases, the old supplier, the new supplier, carriage inwards, and then the closing inventory based on the £125 total cost of the product.